Hi, I'm Mark for Arlington Hall Investment Advisors. Too many business owners and business leaders either don't know how to transition their businesses or don't care to learn how to until they have to learn. Consequently, money is left on the table, money that could have been part of the seller's legacy wealth. What follows is a vehicle for you to learn how to transition, different variations, and how you can work now in order to realize the best outcome possible when it comes time for you to transition your business and for you to build your legacy. Valuation. Valuation is only a starting point for setting expectations and negotiating a transaction. Valuation and deal structure are inextricably linked. Each valuation method has pros and cons. Cash flow is the most relevant basis for making a valuation. Getting to know your neighbors. Get to know the number and the types of transition partners that are in your chosen market. How much competition will there be for you to do a deal with your ideal type of partner? How do you stack up against the competition? Sellers need to understand the criteria of the potential buyers in their market. What are your firm's biggest strengths? What kind of firm will pay a premium for them? Many buyers are looking for growth and cost synergies. How strong is your growth story? What efficiencies do you bring to the table? Sellers also need to understand the financial impact of dealing with a specific type of transaction partner. Sales to internal partners are often subject to a discount. What kind of trade-offs are you willing to make on control, price, and timing? Some external buyers will include equity in a deal. Question number one, what does a successful transition or transaction look like for you? 4 ingredients are managing your clients, concentration of your clients, know-how of your operations, your brand name recognition. It's important for you to be honest with yourself and know what you want from a transition. As one consultant said, if selling for you is all about the money, you'll be better off working for another 10 years and running your business straight into the ground. 4 goals of structuring a transaction are to balance the risk properly between the buyer and the seller, to address the strategic priorities of all stakeholders, to address the professional priorities of all stakeholders, and to address the personal priorities of all stakeholders. Risk is anything that prevents or reduces the likelihood of a seamlessly transferring your business from you to a buyer. Buyers and sellers consider risks related to preserving client relationships, retaining staff, federal and state regulatory filing liabilities, continuing operations. The 4 key structural elements at play in any deal are risk, reward, control, and duration. And these structural elements are established using 3 levers: cash, debt, and equity. The more cash involved, the higher the risk for the buyer, which can lower the valuation. Conversely, the longer the payout period, the more risk for the seller. If control is transferred, but the payout is delayed, the seller may ask for a premium. The source of funding is also an important factor. The buyer using debt financing can increase the risk for the seller, as the seller's claim may be subordinate to the lender's claim should the transaction fall apart. A buyer may also offer equity at closing and at each earnout milestone. But if equity is involved, a seller must feel confident that this currency is going to be liquid when it comes time to sell. Taxation is important whether the transaction proceeds to the seller are treated as ordinary income or as capital gains. The entity type is a starting point for determining the options. Tax treatment need not be a zero-sum game. Many times, the buyer and the seller may be able to achieve favorable tax treatment. Many assets being sold may be goodwill and other intangibles, plus any material hard assets included in a sale, like property, plant, or equipment. Intangible assets can include non-compete agreements, client lists, management agreements. From a seller's point of view, proceeds from the sale will be treated as either capital or ordinary gains. From a buyer's perspective, such intangible assets are generally written off over 15 years. There are three what are called pass-through entities and one that is not a pass-through entity. Pass-through entities include sole proprietorships, LLCs, LLPs, and S-corps. The one entity that is not a pass-through is C corporations. How does your entity determine your tax liability? Sole proprietors are taxed at the individual taxpayer level. LLCs are taxed at the individual member level, LLPs at the partner level, and S-corps are taxed at the individual shareholder level. When a C corporation sells stock, it is taxed as capital gain at the individual shareholder level. Let's break down the taxes for each entity. For sole proprietorships, computers and servers and goodwill and client lists that were acquired are taxed as ordinary income. Goodwill and client lists that are self-created are taxed as capital gain. For LLCs and LLPs, computers and servers are taxed as ordinary income, and goodwill and client lists are taxed as capital gain. For S-corps, computers and servers are also taxed as ordinary income, and the sale of stock is taxed at the individual shareholder level, and goodwill and client lists are taxed as capital gain. Finally, for C corporations, the sale of stock at the individual shareholder level is taxed as capital gain. The gain on the sale of access are taxed as corporate income rates. When there is a corporation that distributes the sale proceeds to shareholders, the individual will likely have dividend income. The way this plays out in real life includes examples such as a partner merged his assets into the acquiring firm using the Internal Revenue Code, Section 351, tax-free incorporation. Another example is a straight stock sale from a different minority partner to a new incoming partner, which was handled as an installment sale. Another example, a stock sale to a younger partner, which was seller financed, and the structure allows the buyer to have enough after-tax income to use the distribution to pay for the stock. Valuation. How to use valuation in context of negotiation. Valuations are used to prepare for negotiating a successful transaction. A consultant observed, most people don't even know what their firm is worth because they don't know what drives the value or what detracts from it. Effective negotiations require looking at the deal from the other side's perspective. M&A advisors and investment bankers have well-developed concepts and models for doing so. They include the profit and loss recast, or P&L recast, the P&L look-through. When advising buy-side clients, M&A consultants depend a great deal of time on analyzing and dissecting the economics of the target organization. What are the areas of value? What are the growth trends, red flags within the financial statements, and client demographic data? The seller can assist by collecting corporate documents, financial statements that clearly identify each revenue stream and its associated cost, detailed client demographic data, and obligations and liabilities such as leases. Two terms sometimes foreign to a business owner are recast. This is where buy-side analysts envision and forecast what a combined entity might look like. This forward-looking view is called recast. It looks at either revenue synergies or cost synergies that will demonstrate that the transaction will be accretive for the buyer. Look-through. At the same time, the seller may be doing their own due diligence. A sell-side analysis of potential synergies is called look-through. The seller looks through to glean what the buyer might see in recasting the seller's financial statements. The purpose of this process is to quantify the potential synergies on both the revenue and the cost sides of the equation through detailed financial forecasting. In general, however, the split is never 50-50. When two parties disagree on a price, they should not randomly select some number in the middle of their numbers and split the difference.